We have corporate bonds, and again in corporate bonds we can subdivide into the bonds that are issued by financial corporations and the ones that are issued by non-financial ones. We can talk about securitized bonds, wherein a special purpose vehicle comes into a picture, and the bonds are issued through the special purpose vehicle. So some kinds of bonds like mortgage backed securities, asset backed securities falling under the category of securitized bonds. So different kinds of issuers can very well create different kinds of bonds. So whenever we are looking at the global market, we can categorize the entire global market based on the type of the issuer. Similarly, we can think of doing the classification based on credit quality. We should understand here that every bond is actually rated by a credit rating agency. Every issue is rated by a credit rating agency. Probably S&P and Moody's are more and more popular in the United States. Similarly, they are popular across the world itself. But of course, we do have some country-specific credit rating agencies also operating in some countries. But whatever is the mechanism, every bond issue is given a kind of a credit rating. When I look at it from an S&P's perspective, triple A is the kind of a rating which carries a highest credit quality, right? Triple A is carrying the highest credit quality, followed by double A, then A, then we are talking about triple B, double B. So anything that is above this is categorized as an investment grade bond, and anything that is below this, which is below this, means there could be a B, there could be a triple C. So any kind of a rating that is below the double B kind of a rating, double B and below double B kind of ratings, we are classifying it as a speculative grade. So in some cases, the speculation grade is also called as a junk bond, or also otherwise called as high yield bond. So we can very well classify the overall market based on the investment grade bonds versus the speculative or junk bonds. And what we typically observe is some companies, while they are allowed to invest in speculative bonds, some companies do have very strict restrictions, either because of the regulators or self-imposed. Let's say an insurance companies or banks, they generally think twice before they invest in speculative or junk bond. So they are prohibited for some organizations for investment. So the overall market is classified based on the credit quality of the bonds issued. There could be a different dimension to the classification based on the maturity period of the issue itself. While some bonds can be issued for lesser than 1 year, typically classified as money market securities, but the ones that are issued for anything more than 1 year, we classify them as a part of capital market securities. So the overall bond market can be categorized based on the maturity period. But the other way to look at coupon based, depending on whether the coupon is fixed and specified in terms of percentage to the par value as a part of the bond indenture itself, or is it floating? When I am saying floating, we know that it could be based on a reference rate, either a LIBOR or Euribor or any kind of lending rate, any kind of a reference rate which keeps changing with time. That is being taken as the reference rate, and if possible a margin is added on the top of that, and that is what determines the floating coupon. Generally, a lot of financial firms, let's say, whose liabilities are floating, means they have to make the payments on a floating rate basis, They prefer their assets also where they are investing. They prefer their investments also, the returns to come on a floating rate basis itself, so that the volatility of the assets and the liability mismatch can very well be reduced. So they prefer investing in floating rate, especially if their floating rate liabilities are higher, so that even if the interest rates increase, because of the floating rate liabilities, the value of the liabilities is not falling down, but the value of the assets is falling down. The present value of the fixed assets will fall down, but floating liabilities may not fall. That's the reason the financial institutions which have floating rate liabilities, they prefer their assets, which is the investments, also to be primarily on a floating basis itself. So across the world, we can very well classify the securities based on the coupon structures as well. Now, if you see here, whatever is the type of classification, they are suited. Some of them are suited for some kind of investors, especially when I look at fixed coupon bond, someone who is not willing to take any kind of a risk and is ready to sacrifice his return for the additional risk. Those kind of investors typically prefer a fixed rate coupon structure itself. Whereas someone who is willing to take a risk, want to increase their coupons with the interest rate increase, and they are ready to forego their coupon even if the interest rate goes down, they are preferring for a floating rate. So, and someone who wants the returns within 1 year, they typically are the participants for money market transactions. Someone looking forward for beyond 1 year, they are more and more game for capital market kind of investments. More risk-taking investors look at speculative or junk, whereas less risk-taking kind of investors. Here, when I'm saying investors, need not be individual investors alone. I could very well talk about institutional investors as well. So the credit quality, investment grade indicates a less risk-taking structure. So all the investors who are willing to avoid the risk, they choose investment grade securities. Someone who is the risk-taking kind of investors, they are more and more preferring for the speculative grade or a junk grade. The same risk, the same kind of a classification of the investors can go based on the issuer type also. Normally, the government bonds are treated to be less risky because government hardly defaults on its borrowings. Whereas corporate, yes, some corporate may not default at all, but for some corporate, if their operations are not financially sound, they can very well default on their commitments towards interest and principal repayments. So again, the investor who is more risk taking may prefer corporate kind of bond, because generally what we observe is high risky securities typically have to give higher yields to compensate the investor for the additional risk that he or she or the company is taking. So this is one classification which we look at. Then there could be a couple of other classifications of the bond markets across the world based on the currency, dollar denominated bond markets or yen denominated bond markets. So again, based on the currency, there is a different classification. Or I can talk about the geographic location. We have already discussed a little bit about these three categories of bonds. The domestic bonds, especially if I'm talking about US as the domestic country, then a US incorporated firm issuing bonds in US denominated in dollars, we call them as domestic. Whereas if I am talking about an Indian incorporated firm, non-US firm, issuing bonds in US issued in dollars, they are called as foreign bonds. And typically any company, let's say a US incorporated company issuing bonds elsewhere, US company issuing bonds elsewhere and any currency, obviously these two not being the same, right? If these two are the same, then it becomes a foreign bond. So these two not being the same, I classify them as euro bonds. So this kind of a classification can very well exist in the different kinds of bonds. Then one more broader classification I could see with respect to the bonds is again on the geographic structure itself is the bonds issued in the emerging markets versus developed markets. What are these emerging markets? Especially those kind of countries whose capital markets are not fully established. They are not fully efficient. Capital markets are not fully efficient, not fully established. We call those kind of markets as emerging markets. They are prone to higher risk, which means higher returns or higher yields should be provided for the investors who are investing in those kind of markets. So typically developing countries, developing markets would be categorized under the emerging markets where the potential for earning profits would be much higher, but along with the same time the risk also would be much higher. Whereas on the other side, if I look at a developed market, the risk is much lesser and hence the yields associated with the investment in those markets is also much lesser. Then another broader classification I can look at with respect to the interest with respect to the bonds is the index linked bonds. So sometimes the linking could be with respect to an inflation index like consumer price inflation, consumer price index or a wholesale price index, or it could be something linked to an equity index or a commodity index. Any kind of published index based bonds could very well be created. But what we typically see is majority of these kind of index linked bonds are issued by the government, though even a private corporation generally which is having a very high credit quality, which is financially more and more sound, can also very well issue these kind of index linked securities. And there could be one more classification based on tax status. There are some bonds which are issued, let's say, by government or any corporate, which have that flexibility of being exempted from income tax, whereas some of them or majority of them, the interest is typically taxed as income tax. So the bonds which are typically exempted from income tax, they carry lesser yields because one, their risk is much lesser and there is no loss of income after tax. So generally the yield that is associated with tax exempt securities, right? The tax exempt securities, whatever is the yield, I should try to compare it with the yield that is coming on taxable securities or taxable bonds. Whatever is the yield, I take 1 minus t of it to finally compare which of these two kinds of bonds are more and more preferable. So this is one more kind of classification that we see with respect to the bonds in the global market. So a simple way to put it up is the bonds across the world, they can be classified based on various dimensions like this. So those many variants of products are there, which means if someone has to really create an index based on the bonds, any of these or any combination of these can be clubbed together to create a bond index. That is what will make the composition of the bond index more and more complicated. Sometimes the bond index can be created based on the geographies. Sometimes it could be created